Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stanovac. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
A new round of crypto ETFs focusing on smaller coins make their Wall Street debut even as the government shutdown stretches into its 29th day.
Plus, we speak to the CEO of Securitize as it plans to go public and makes a deal to bring CLOs onto the blockchain.
And we'll also speak to another CEO, Matt Cole from Strive, as the digital asset treasury model comes under pressure.
That's all ahead over the next half hour right here on Bloomberg Crypto. First, though, let's take a step back as we get toward the end of the month and take a look at just how Bitcoin did in October. If you fell asleep at the beginning of the month, you woke up today, you'd say, wait, nothing actually happened. But that is not the case. It surged in the early part of the month. Just look what as high as $125,000 per Bitcoin. Then the biggest liquidation in crypto history. Look at the range here, down to, look, just about $107,000 at one point. But for the whole month, the last 29 days, yes, we got a couple more to go until Halloween. Just down about 2.8%, Scarlett.
All right, thank you for that update on the price action. I'm looking at the growth in stablecoin usage. Just yesterday, Western Union, one of the oldest payment firms, announced that it too is getting into stablecoins built on the Solana blockchain. Consumers and businesses are using stablecoins to make real-world purchases and payments at an accelerating pace since the passage of the Genius Act. More than $10 billion moved through stablecoins in August. That is according to Artemis Research, which means that at this pace, stablecoin payments could reach $122 billion over a full year. Staggering. Tim?
Yeah, that's just a huge change from what we've seen over the last couple of years. It's not just stablecoin usage that is growing. New ETFs focused on smaller coins made their debut this week. That includes the Grayscale Solana Trust ETF, Canary Capital's two funds, Litecoin and HBAR, and the Bitwise Solana ETF.
Canary CEO Stephen McClurg about these launches yesterday. Take a listen.
When the SEC approved the generic listing standards for cryptocurrencies back in September, that actually paved the way for what we're doing now. Opened up the exchanges to be able to launch any cryptocurrency, single token cryptocurrency ETF that actually has a futures market in the US.
Let's bring in Katrina Paglia. She is Chief Legal Officer of Pantera Capital Management. Her firm counts Bitwise as one of its 250 portfolio companies, and Pantera seeded Bitwise's Bitcoin ETF. Katrina, thanks for joining us here.
Thank you for having me.
So I'm curious whether you advised Bitwise on the launch of their Solana ETF, since it was done during the shutdown and it was done through this, I guess, roundabout way that wasn't available before.
Sure. So as you mentioned, we were one of the seed investors in their Bitcoin ETF, and they are one of our portfolio companies. We have a great relationship with them, but we were not directly involved in the Solana ETF. So happy to talk about what we understand as to how that actually did get launched during the government shutdown, which I understand might seem a little bit bizarre, right? Like, it's kind of an interesting timing.
So do it. Yeah, tell us how that happened.
So there's actually not any super crazy story here. So in September, the SEC issued these new guidelines for listings for certain exchange-traded products. They're basically give sort of a direct launch, provided that you meet certain criteria. Criteria being the underlying reference asset is something that is already been approved in this type of product. No new novel features, no additional, futures or any sort of additional kind of tweaks to the product. If you have an existing framework, which obviously you've seen Bitwise with the Bitcoin ETF, the ETH ETF came out right after that. The Solana ETF was very similar, and it kind of fit that mold to go under these new listing standards to either go to NYSE or NASDAQ. I would say, however, that's all good and makes sense. The behind the scenes stuff is like, this didn't just happen overnight, right? Like, you don't just file an application. It doesn't just go live in 20 days. We know that Bitwise was speaking to the SEC. They were going, back and forth, right? They have these conversations. They were fairly certain that when they put the application, that they were going to meet these criteria, similar to these other ETFs that launched, right? Like, this isn't just you file it during the shutdown and it gets launched. I think the other thing that's really important to note, we're in a government shutdown, but that doesn't mean there's literally nobody working. There are skeleton crews at all of these agencies. So there was an opportunity if somebody were to look at these applications and say, you know what, you don't fit within these criteria of this new listing standard that we've announced for an accelerated launch. We're going to actually put the stop here, and we're going to make you kind of come back and forth and go back through a more longer comment period.
So if the SEC stepped in and contacted anyone at any point, then that would be the signal that this is not going to go ahead. That didn't happen with these 3 launches.
Evidently, yep.
Does the successful launches of the Bitwise Solana ETF and the Canaries pair of ETFs provide a path for more issuers to use this more streamlined approval process? I mean, do you think that this will become a thing, continue to be a thing, even after the government shutdown ends?
I think so. I mean, they put these new listing standards out there for a reason. I think the timing is just really interesting that it happened to come out during the shutdown, but the plan would be to kind of create efficiency for launches. It's better from a resource perspective. And again, if you're within this very limited framework where you actually have this pre-existing thing that you're just modeling after, it makes a ton of sense.
But if you don't have that, then the shutdown could slow you down.
Oh, 100%. Then you're back to just a typical launching an exchange traded product.
So let me ask you, does as Scarlett mentioned, day 29, is that?
Day 29.
I'm glad we're keeping, yeah, I've lost count. Does it slow down your world at Pantera at all?
Not from the fund perspective. I think with the portfolio companies that are hoping to IPO, we saw some really successful ones already with Circle and Figure, and that was really exciting. I think those who are in the queue and were in the queue when the shutdown started, that's frustrating at this point. So it's more kind of from our portfolio and our platform perspective that we're starting to, you get a little frustration. Are we at the longest shutdown yet, or
Not
second
yet,
longest?
But
like we're getting there.
We're getting there.
Yeah.
I guess that raises the question, what role, what purpose does the SEC really serve then in the launch of some of these ETFs if it can pretty much not say anything and things will go ahead?
I would recontext that thought. So the SEC put the standards out there. So it's not like they're saying, hey, free for all. They're saying in this limited circumstance with these exchange traded products, again, if you have like this pre-existing kind of roadmap that you're duplicating with maybe a different reference asset that's very similar, yeah, and they still have the ability to stop it. But I think you're still going to see the majority of people going through the standard listing process. But this is an alternative that I expect to see to continue.
We have time for just one more question. You said more than 200 portfolio companies at Pantera. The biggest area of opportunity that you see moving forward right now, what is it?
So we're really excited about the DATs right now. We launched our own.
You're not the only one.
Yeah, right.
But that might be an issue.
Right. There's an argument that it's just the hype right now. I do think that DATs are distinguished by their asset management class, and like ours, the Solana company HSDT one that we just launched, we obviously believe that we're differentiated because we've been in this space for so long. Moving aside from DATs, I think there's a significant amount of, real world use cases just from a venture investment opportunity set that we're seeing going forward for our new fund. So it's just, I think what we're going to see is like blockchain's going to exist when you don't even realize it exists with some of these projects that we're really excited about right now.
And just for anyone who's just joining us, digital asset treasury.
Yes, digital assets, yes.
So hot right now.
So hot.
Yeah. Pantera Capital Chief Legal Officer Katrina Paglia. Always good to see you, Katrina.
Thanks
so much for joining us. Hey, coming up next, Securitize's CEO Carlos Domingo talks about the rise of tokenization as they launch a tokenized CLO fund. Plus, Strive, the CEO Matt Cole talks about digital asset treasuries, those DATs again, and buybacks too. Also, to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg. Well, it's now official. Securitize is going public via a SPAC with Cantor Equity Partners 2. The deal values the company at a $1.25 billion pre-money equity value, and it plans to tokenize its own equity. We also learned today that Securitize is launching a tokenized CLO fund. To discuss all of this and more, let's bring in Securitize CEO Carlos Domingo. Carlos, good to see you. Why do CLOs need to be on the blockchain?
Look, I think everything needs to be on the blockchain, right?
Really?
The blockchain is a better ledger, and capital markets run on antiquated ledger technologies that are silo, are not connected.
So is everything that's not on the blockchain going to be on the blockchain?
I think so. I think we're going to tokenize the world, and everything that is on a ledger will upgrade to a better ledger technology, and that's what a blockchain is.
So what does tokenization of CLOs do? Who does it serve most?
So look, one of the most successful tokenized products are treasuries. Obviously, we have the largest one with the build product from BlackRock. And if you think about where the market is heading, interest rates are coming down. So people are going to be looking for things that are a higher interest than than treasuries, but they still are safe and liquid. And CLOs is kind of like the most adjacent thing. This is a AAA rated CLO product.
So potential investors or existing investors?
I think both. We're getting the 100 million seed allocation. This is going to be our 7th fund that has tokenized fund with more than $100 million from Grove, which is part of the Sky ecosystem, the former MakerDAO. It's an existing investor, but they're just putting additional money into this new product. So
I want to dig into the idea of everything being tokenized. I mean, I think if we could have a theme for 2025, perhaps that would be it. I mean, Vlad Tenev talks about this at Robinhood, putting private companies on the blockchain so people can have access to them. But at the end of the day, there are these rules about who can invest in these sorts of things. The idea is investor protection, and if we open those things up to people who may not be so-called accredited investors, is that dangerous in some way?
Actually, tokenization doesn't change those rules, right? So tokenization is just upgrading the ledger where the securities sit to make them easier to transact, consume, etc. But if a product is only for accredited investors, it's still only for accredited investors, even if it's tokenized or not. So there's a misperception thinking that tokenization changes the regulations, and that's actually not true. So I don't think that there's any additional risks on tokenization that on traditional, capital markets rails. It's actually the opposite. You get more, transparency, insurance about the ownership, etc. So.
Does tokenization matter as much to retail investors as it does to institutional investors?
I think it matters a lot to retail because at the same, any technology that, makes things cheaper, easier, more accessible, obviously pending the regulatory, framework, makes it easier to consume for retail people. Like, large investors, they have armies of people that they can deal with inefficiencies in markets that retail people don't have. So I think it's a great equalizer for accessing financial services products.
So if this is about the rails and about changing the rails, getting things that are not tokenized, so then they're more easily accessible, things are faster, things settle more quickly, who ends up losing out here?
That's a very good question. I think the incumbents, right? The intermediaries that sit in between those transactions.
Who are they?
Clearinghouses, central securities depositories, transfer agents we need to modernize. So transfer agents think they'll still be there, but in a modern version of them, distributors like wealth management.
Give us some names.
You want me to be provocative?
Yeah, well, I just want you to, if you're thinking about a future like this, like where do people not want to be?
I think one of the things that probably disappears is the clearinghouses, right? Because the blockchain settles the trades, and the blockchain is the settlement layer, and therefore you don't need an intermediary to settle trades.
Are we just going to hear the clearinghouses at some point say that they're going to tokenize whatever's in their inventory as well?
Well, they are already saying, but that actually doesn't change anything, right? Because tokenization is about changing the market structure to eliminate intermediaries. So if the existing intermediaries are just stay there as intermediaries, but tokenizing something, it doesn't really, create any improvements to the market structure.
Do most people not even notice? Let's say we get to that world where everything is tokenized. Will the end user not even notice this world?
That's a very good question. So I think that tokenization or tokenized finance eventually will become finance, the same thing that internet companies are just companies today, right? So I think blockchains at some point, when they are integrated on the endpoints of consumers, will just disappear behind the scenes as another infrastructure there, the same way that internet. Back in the days, you might remember you had to dial up and have a modem and all that stuff. And today, everything is connected to the internet and it's transparent, right? So I do think blockchains will eventually become completely transparent.
Can AI achieve the same efficiencies that tokenization claims to create?
I think these are complementary topics, right? They're not one replaces the other one. AI is about providing intelligence to things. So I think that AI on top of tokenized assets could actually make trading strategies, et cetera, much more efficient, but it doesn't necessarily mean that you don't actually need tokenization.
I think you're making a clear and concise case about why you believe this needs to happen. What's preventing it from happening overnight?
As we mentioned, you said, are they going to be transparent? Well, they're not transparent today, right? Today, to consume tokenized assets or digital assets in general, you need to download a wallet, or you need to have private keys, and you need to be connected to a blockchain, and maybe there is another blockchain that you need to bridge assets. It's a complicated user experience, which is great for early adopters, like most of the native digital people and the crypto people, but it hasn't actually trickled down to the mainstream consumers, because we need to make it easier to consume, more transparent, and less roadblocks to do it.
Is there any asset or any product that a financial firm sells or puts together that can't be tokenized?
No, everything sits in ledgers, right? So this is upgrading the underlying ledger technology. So Everything can be tokenized.
They told me this when, years ago when we bought an apartment, and then this needed to happen, and then like the title person shows up, and you're like, why am I signing this piece of paper?
And you wrote another check to the
paying,
title person.
yes,
correct.
And then 6 years later, we sold and bought a new place. The same thing. Like it didn't. Everything that was supposed to happen didn't
Your
happen.
house did not get tokenized?
No.
Well, so title is a very good example
The
where
title's
the
like in a file
existing
somewhere.
regulations are so convoluted and they're like, district by district, etc. That makes it very difficult. I think securities it's easier to get tokenized because we have federal regulations and across the country is the same thing. Title for real estate is a very complex topic.
Seems
the
like the most
filing
simple
cabinet
thing that
makers
needs to
But
don't
it should
want
be
it to
digital, right? Like
tokenized.
everything is digital. If you think about music is digital, broadcasting is digital, communications are digital. So why are finance not digital yet? This is like an unavoidable trend that is going to happen ultimately.
Yeah, this is turning into a very philosophical conversation. Carlos, really appreciate your joining us. Carlos
good.
Domingo
Thanks for
is
having me.
Securitize's CEO. Now, outside of Securitize, another story we're following is Trump Media getting into prediction markets, which of course continues to be a huge trend that we're seeing all this year. Trading with event contracts has really surged in recent months as names like Polymarket, Kalshi, CME, and ICE are all becoming involved. Trump Media will use Crypto.com derivatives in North America to enable its prediction wagers.
Well, coming up, Strive Asset Management saw its stock surge earlier this year, but it's since cooled down like many companies connected to digital asset treasuries. Strive even made a move last month by paying a premium to buy Semler Scientific, another company holding Bitcoin. Strive CEO Matt Cole joins us next. This is Bloomberg.
The purpose of a digital asset treasury company is to be able to engage in structured financial products that the market wants. It's because it can convert those spot assets into slices of exposure that add value to certain investors relative to just buying Bitcoin at Coinbase.
Strategy board member Brian Brooks, that was just last week. Well, a newcomer in the crypto space making waves is Strive. The Bitcoin treasury firm co-founded by Vivek Ramaswamy is on a tear since announcing its conversion from a biotech company into a Bitcoin treasury in May. Strive CEO Matt Cole joins us now. We're going to talk about the deals of late, but also about this conversion. Why was it the right move to move away from biotech and go into digital asset treasury when it seems like there are so many other DATs out there right now?
Yeah, so Strive actually started as an asset management firm. Our co-founder Vivek has a great biotech background, but for us, we saw, ultimately our goal for our shareholders is to maximize value. And when you come at it through the lens of Bitcoin, it's frankly just hard to beat the hurdle rate of Bitcoin. And if you can't beat the hurdle rate of Bitcoin, you should just buy it. And so that ultimately became the answer of what we think and what we see as the way to maximize value over the next 10 to 15 years. And we felt like our asset management background was going to be uniquely helpful in building out the right capital structure. And we've stated intentions right now to launch a preferred equity instrument in 2025 and really be leaders and be laser-like focused in building out the digital credit market, which I think could be in the trillions of dollars as this grows, and offer two forms of Bitcoin exposure. Our common equity, which we view as amplified Bitcoin exposure, and then if we successfully launch preferred equity this year, like we're aspiring to do, then there's amplified digital credit exposure, and those offer double-digit returns.
Is there any semblance of the biotech company that Semler Scientific was in Strive now, or is it a complete 100% DAT?
Yeah, so Strive is a 100% DAT. We obviously have an operating business, Strive Asset Management. It's a small business. We've stated publicly that we expected in 2026 to either have a single-digit million loss to single-digit million gain, depending on how it grows, but effectively very small relative to the Bitcoin treasury. With regards to the Semler transaction, I think that there's two reasons why that deal made sense for both Semler and Strive. One, on the Bitcoin side, it obviously helps us scale up our Bitcoin holdings, which allows us to bring down any management costs for a Bitcoin treasury company. Two, I think that they saw us as leaders in building out digital credit and how that ultimately will accrue value to us as a Bitcoin treasury company. And then three, leveraging our network, whether it's Vivek Ramaswamy, our co-founder, Ovik Roy on our board, Ben Pham, our CFO, who all come from the healthcare and biotech space, to actually give the similar operating business a broader mandate, which we think will drive value to both shareholders. But then on the Bitcoin treasury standard with Bitcoin as our hurdle rate, ultimately we would look to monetize that in some way that benefits all shareholders.
Matt, help us make sense of the math here. This was this deal last month that you guys announced, agreeing to acquire Semler Scientific in an all-stock deal that values Semler at $90.52 a share. It's trading now at $26.85 a share. Why is there such a big delta there?
Yeah, so I think this is a disconnect in how Bitcoin treasury companies see the world versus how traditional markets see the world. So both sides view the world in terms of Bitcoin. And so in terms of Bitcoin, if you do the math of the original basically a reasonable deal for both sides that values Strive slightly higher, given our clean capital structure and our ability to be leaders on the Bitcoin treasury side. And so that's where I think it makes sense. And then we obviously, for compliance and legal reasons, you have to convert that to a fiat number.
So Matt, before we let you go, I noticed that prior to Strive, you spent 15 years at CalPERS, one of the state's biggest pension funds, where you actively managed fixed income portfolios. That's a pretty dramatic portfolio to go from the staid world of fixed income to the wild west of crypto. How did you make that move?
It actually was the reason I became a Bitcoiner in the first place. I was managing a large portfolio of U.S. Treasuries. I was probably one of the largest buyers of U.S. Treasuries in the United States. And talking directly to the Fed, to the Treasury, it gave me conviction as a once Bitcoin skeptic that Bitcoin was the only answer to the debt crisis and the fiat currency debasement. And fiat currency debasement as an investment opportunity is kind of becoming popular in Wall Street circles now. But for Bitcoiners, this was a core part of the thesis, and obviously the other being true financial freedom and an opt-out from a system. But the debasement trade, Bitcoin's the only answer. And I think that a lot of Bitcoiners, including myself and Strive, have conviction that the US government's never going to stop printing money. The debt crisis is a bipartisan issue. And as an American, I'd love to see it be solved, but I am not optimistic on it being solved. And I think that only provides more and more tailwinds for Bitcoin and people that invest in Bitcoin.
Matt, we only have 10 seconds, but do you see crypto or Bitcoin specifically replacing fixed income at big pension managers? Just 10 seconds.
I think Bitcoin is going, and digital credit is going to grow in exposure in institutional circles. And I think you saw that with today, or this week, with Strategy getting a credit rating.
All right, Strive CEO Matt Cole, formerly of CalPERS. That's all for Bloomberg Crypto. Join us again next week. Keep it right here. This is Bloomberg.